But Ron, thank you so much for being on. I really do appreciate you being here. You had recently wrote an article for Forbes called "The Checking Account War is Over and the Fintechs Have Won." Tell me a little bit about your research here. I'm super excited, and let people know where you're from and what you do.
Tanner, thanks a lot for having me on. I'm Chief Research Officer at a consulting firm called Cornerstone Advisors, which is based out of Scottsdale, Arizona. Not to be confused with a investment management firm called Cornerstone Advisors. We focus a lot on serving the mid-sized bank and credit union space here in the U.S. A lot of technology strategy, performance improvement. And having said all of that, I don't actually do any of that. I run a research group, very much like an analyst firm, like a Forrester Gartner. I worked at Forrester for a long time. So I focus a lot on I like to call it the intersection of supply and demand for technology in banking. So I'm looking a lot at consumers. I'm looking a lot at what's happening on the financial institution side and what they should be doing to improve their delivery of technology. So the article that you referenced, the genesis of this, Tanner, actually started 3 years ago when I conducted a consumer survey, and this was just U.S. consumers. And I asked them 3 years ago, and in fact, it was just right about exactly 3 years ago, middle of the year, 2020, right after the pandemic had started. And I asked them, when was the last time you opened up a checking account? And then who did you open that checking account with? And what I found was that from 2017 through 2020, through the first half of 2020, the percentage of consumers who were opening up accounts with digital banks or fintechs or neobanks, challenger banks, whatever you want to call them, had grown very significantly. At the time, so did the share of the mega banks, the Bank of America, Wells Fargo, JP Morgan Chase, Citibank. Even their share had increased between 2017 and the first half of 2020. Over the past 3 years, I've had a lot of people come to me and go, "Hey, when are you going to update that? That was cool stuff. We'd love to see that again." So I had I was fielding a survey of consumers just a few weeks ago and said, you know what, it's time to throw those questions back in there and ask them again, when was the last time you opened up a checking account and who did you open that account with? And I prompted them with probably about 60 choices. 45 of them were the large super regionals and above. And then I gave them, a community bank not on this list or a credit union not on this list. And then the other 15 or so were a lot of the fintechs and digital banks. So Chime, Varo, Aspiration, but Square Cash App, PayPal, SoFi, and so forth. And the results were somewhat surprising, but not all too surprising. The market share of the challenger banks, fintechs / neobanks, whatever you want to call them, digital banks. This year alone, first half of the year, those fintechs captured nearly half of all new accounts that were being opened up. Huge increase over 2020. The other big change from 2020 is that the market share of the mega banks declined by about 8 points, as did the share of the large regional banks. The community banks and credit unions pretty much held their own ground, but we're talking only about 10% between the two of them. So big jump in market share gain over the past 3 years by the digital banks and fintechs.
Maybe I can share my screen so then we can see this here.
Would have helped. I could have had the numbers. There you go, from 36% to 47% over the past 3 years. And then the mega banks declined from 24 to 17, and the regional banks declined from 27 to 21. So yeah.
Yeah, very, very specifically, because you even wrote about the winners and losers. I'm a big fan of SoFi, just as full disclosure. I hold that company on public markets. You said in 2020, SoFi accounted for 1% of new account openings, while Wells Fargo held a share of 8.1%. In the first half of 2023, SoFi's market share quadrupled to 4%, while Wells Fargo's share dropped to more than half to 3.5%. Um, that was really interesting to me, knowing that this large shift is happening, let alone how many accounts are being opened right now. I wanted to touch on that as well, but uh, why is there a massive shift over to digital banking even now in 2023, knowing that this is maybe not just sort of a COVID related move anymore? Like we're kind
Yeah,
of past that, but yet people are still choosing these options.
sure. Before I address that, though, Tanner, I want to make sure people are clear about the reference to the term market share. That was market share, that was share of the new accounts that were open. It is not market share of all accounts.
Correct.
It was the share of, the market is the new accounts open. So I probably could have made that a little more clear in the article itself, but that's important to understand because that SoFi does not have 4% of the total
Yeah.
market.
Yeah.
So why is this? Well, first, let me tell you what's not a reason. It is not simply because they have a better digital account opening process. The mega banks and to a large extent the large regionals have decent online digital account opening processes. They do a pretty good job of it. Bank of America in particular, Chase, Wells Fargo, they do a good job. That's not the reason. It might have been more of a reason in 2020, especially as the pandemic started to hit and branches closed. But I think there are two reasons in particular, and perhaps a third, but that third we can argue this a bit. But the reasons that I think are predominant for it is number one, they're offering a different product, Tanner.
Yeah.
The banks are offering checking accounts. What the fintechs are offering, to some extent, defy categorization. Square Cash App is a great example. What is it? Is it a checking account? Is it simply a payments account? I don't know. You can get rewards. You can make investments. You can buy crypto. There's a tax prep capability. There's direct deposit. There are all these functions and features that, from a traditional bank, an additional banking product perspective, cut across the product. So it defies categorization. And I think what's important there is you got to remember that about 70% of all the new accounts that were opened so far this year were opened by Gen Zers and millennials, basically consumers 21 to 42 years old. They don't care about a, quote, checking account, and it isn't because they don't write checks. It's because they want what they want, which is a whole bunch of stuff to be able to do, while the banks are still very much driven by a narrow product definition. There's a checking account, there's a savings account, there's a CD, there's an investment account. You want all of that, you have to open all these different accounts. The banks are doing a much better job of integrating those accounts into a single view, but the reality is that they're still separate accounts with separate numbers, and you have to transfer funds from one to the other and do all this kind of stuff. Whereas the fintechs are really kind of coming to the table and going, we just provide you an account to do whatever it is you want to do. So I think the product itself is very different. And the second thing that I think is really important here is they're just simply doing a better job of marketing, and I think a better job of both advertising and market segmentation. I think the banks, the mega banks in particular, because they're so large, don't do as good a job of sort of identifying the various niches and segments within the population to market to. So I think they actually capture a good percentage of the consumers who don't care enough about banking to make a smart decision.
Sure.
And that's a good number of people, and it drives that business. But if you look at what the fintechs and the neobank / challenger banks are doing, Chime's a great example. And I will knock them for this business model, but hey, they really understand the low to middle income consumer. It's why they offered early access to the deposit, is why they offer uh, credit builder type products. They understand that segment.
New
The
style of
younger,
overdraft protections as well. All
right,
quite
exactly.
drives that as well. So yeah.
So there's a marketing aspect to this as well. So I think the two predominant factors that are driving their success are the product definition and the marketing. The third piece that I thought might be a little bit more debatable is whether or not the rise in interest rates have impacted consumers, because to a large extent the larger banks have not moved on interest rates.
Yeah.
They get knocked for it, but you know what? Hey, all the more power to them. They don't need to offer 4 or 5% interest rates on savings in order to attract consumers. But I wonder if there's some degree of success, especially in the past 6 months, because some of the fintechs are offering better and higher interest rates.
So, Ron, this is exactly why you are the man I wanted to talk about, because there's been a conversation, at least online in the spaces that I'm in, where that 4.4% that SoFi is offering in their savings account, a lot of people are saying that's been the success of why so many people are signing up for SoFi Money. Now, I know you've done a little bit of digging into Robinhood's cash account as well. They're sort of cash and savings products. Why aren't they doing as well to bring over customers, even though they offer a higher APY for their products? Like, is that really the driving factor for why people are coming over to these accounts, or is there some other sort of marketing tactic that SoFi is doing to attract clients?
I'm not sure I would pin it down to marketing tactic as much as I think it would be appealing to various segments.
Okay.
SoFi has done a good job over the past couple years of attracting. I'm not sure we call them Henrys, the high earning but not yet retired types, but because they're a whole lot younger than not yet retired. But they are, the emerging affluent among the millennial and maybe even to a certain extent the Gen Y population. No, sorry, Gen Z population, not Y. We don't even call them Gen Y anymore. They're
Yeah.
millennials. The Gen Zers and the millennials. I might have made a mistake and called them Gen Yers earlier as well. So we'll go back and fix that one. I don't know how you're going to go back and fix it, but anyway, I think the SoFi has done a good job of attracting through the student loan refi a more affluent consumer. The more affluent consumer is one who checks their rates more often, more the rates on their savings and investments more frequently,
Yeah.
manages their money more closely. I don't think Robinhood has done as good a job, and I actually don't have any data to back this up as much as it is just a theory at the moment, that they've taken a bit of a hit because over the last year, as crypto has declined, I think also as they've gotten a lot of bad press around some issues, and just sort of being the place where if you're a reckless youth who's getting into options trading and things like that, I just don't think they're attracting the same quality of consumer that SoFi is. And look, there's a certain point where if it's choice between a mega bank at 0.2%, SoFi at 4.4%, or somebody else at 4.6%, obviously 0.2 to 4.4 is worth moving for, but 4.4 to 4.6, I'm not sure that's enough to get somebody to start experimenting with somebody they don't work with when they are happy and satisfied with that. Which is why I think the folks who moved to Apple's savings account when it was 4.1%, a little bit less, they're not going anywhere just because SoFi is offering 4.4 or somebody's offering 4.6 or 7. That's not enough of an incentive to get them to move. It's when you start really calculating the money, it's $20 a year, not worth it.
Right. So let me ask you that question then, because this has been a topic of conversation on the channel as well, as Apple actually getting into now the sort of deposit account areas. I know that you've recently done an article talking about Apple Card. What do you think about sort of the talks between maybe Goldman Sachs even getting out of there and maybe Amex picking up the slack? What do you think about Apple right now in the fintech space?
An incredible franchise to draw on,
Yeah.
and it isn't the billion people with the smartphone or the iPhone. It's first, even more narrowly, just in the U.S. They're still close to, but about half the share of the total smartphone market. And from an experience perspective, they continue to do just an absolutely amazing job of delivering a great customer experience when it either comes to account opening, transactions, money movement, all of that. Um, I'm very bullish about their opportunities in the buy now, pay later space.
Yeah.
You know, and they're starting to really bring together a set of products and tools between Apple Pay, Apple Card, Apple Pay Later. They had acquired a credit decisioning firm a while back to help make this. They're building all the pieces to provide a set of products or services. They still need the bank like Goldman Sachs or Amex, whoever's got the banking license from a regulatory perspective to handle some of this stuff, some of the back end stuff. But increasingly, I don't think they're going to need to rely on them as much.
Aren't they getting into some sort of payment processing side? I think Project Breakout or something that they were talking about. Do you have any information maybe on that?
Not a lot of details. They have talked about the payment processing stuff, but to me, what the more significant move was the acquisition of the credit decisioning, because that's the piece that says, okay, we can begin. They can lessen or reduce their reliance on a financial institution to do the credit decisioning, and just rely on the financial institution to basically have the charter. The regulators don't like that. They do not like a rent-a-charter decision. I don't think that's what's prompting Goldman Sachs to move on. I think it's simply their recognition, realization, internal culture and politics that says this wasn't a good move. We should never have gotten into this in the first place. And the folks who did get them into it are probably, now long gone from the organization. So
sure.
But to that extent, there's probably somebody from Goldman who'll see this and go, Ron, you're totally wrong. We are very committed to this. And maybe more so from the large embedded finance approach. But I am somewhat surprised that they're trying to bail out of the Apple relationship.
And I mean, so just because Goldman might not want a part of this relationship, that doesn't mean that this is the end for Apple in finance. I'm sure there will be another person corporation that picks up where Goldman has left off. Do you think that they'll continue to put out new products, or do you think that maybe the sort of savings account and buy now, pay later is sort of where they're going to leave off for now?
Well, it begs the question, what else is there?
Right.
And the first thing that comes to mind is checking account. Would they offer an account that basically takes direct deposits, and does all the things that a licensed checking account would do?
Yeah.
Which is a whole lot of things that they don't do already. But the question begs, how much money would that really make them? Simply having the account. There are still plenty of community banks and credit unions that offer a free checking account. Mm-hmm. But does Apple want to be in the position of having to deal with all of the customer support issues that a traditional checking account entails? I don't think they want that, to be honest with you, Shannon. I don't think they want to do that. I have speculated that what they would do is basically partner with a lot of different financial institutions and in effect kind of provide the front end to this, which is not unlike what Google was planning to do with the Googleplex account. And that kind of devolved into failure as well. Again, I think somewhat because of internal and cultural issues. I don't think it had a lot of support. And when certain people left Google, then the internal support for that product died out. So it'd be interesting to see what Apple does. But it's important to keep in mind that while I have no insight into this, from a personal relationship perspective, I don't think Apple wants to be a financial institution. They're a technology company.
Sure.
They basically want to sell technology, but see financial services as two things. Number one, a place to make some money, which is nice, but more importantly, a place to uh, engage and keep people within the Apple ecosystem and
Yeah.
to expand the ecosystem into not just consumer financial products and services, but products and services for merchants so that they can further drive buy now, pay later, Apple Pay, and get the merchants into the Apple ecosystem as well, because they're smart enough to see that that's where the competition from PayPal and Square are going. And I think why Square is I mean, I can't talk to it from a investment perspective, whether or not but from a logical perspective, strategy perspective, it's having a strong ecosystem of both consumers and merchants makes it a very attractive strategy. Apple recognizes they're behind the game on the merchant side, as does PayPal.
I was going to say PayPal is definitely trying to go after the merchant side now as well, get that similar closed loop.
As
But
does Klarna as well. I wouldn't, I like Klarna. I think what they're doing on the, I wrote an article a few months ago called "Don't Call Klarna a Buy Now Pay Later Company." It's
yeah,
really a commerce platform company, and they have very strong relationships with a lot of large retailers and merchants that they do business with, because they help the merchants influence what consumers buy. And this is why I think banks will fail with their buy now, pay later efforts. We don't care about as consumers, it's not about making the purchase and then deciding we want to spread it out. It's influencing the decision at the point of sale. Who should we choose and which product should we choose? And that's what Klarna does a really good job of.
yeah. Well, while I was reading that, like I said, I went through a lot of your a lot of your articles,
Thanks.
um, and I learned a lot about Klarna. I had no idea about like their creator and influencer platforms. I was like, hey, you know what? Maybe I need to check that out for myself. Shopify does a very similar thing called Shopify Collabs. So that's really what I know. But it's just because it's not a public company, or at least of what I'm aware of. So
Yeah.
I haven't done too much due diligence into them. But I wanted to touch on two main points on the still on the checking account war article that you had touched on. One, you said that if I can read this out, Chime and PayPal dominate the digital bank in fintech category. Combined, Chime and PayPal represent 43% of the new digital bank or fintech account openings of the actual new checking accounts, or 20% of all new checking accounts total. Okay. Now, there's been a big debate, and I know that you're not maybe going to speak on the actual stocks themselves, but PayPal has been decreasing like crazy in its price of the stock over the last maybe year or so, and a lot of people are sort of putting this label on it that this is a dinosaur of the payment industry, and they're going to be losing to Apple. And I'm wondering what your opinion on PayPal is right now, just as a company.
Uh, I think the idea that they're a dinosaur of a company or a dinosaur of the fintech is absolutely ridiculous perspective. First of all, what's the number of accounts they have globally? 300 million, 200
I
million,
I think
something
they
like
just
that.
said that active accounts right now are at 433 million last quarter.
Okay.
So
And you're going to diss that? I mean, and call them a dinosaur? That's huge penetration. That's a huge opportunity. And these are not dissatisfied consumers. In fact, everything PayPal is doing, I think people really understand this. PayPal is the market leader in buy now, pay later.
yeah,
They're the ones who acquired, I forget what's their name, 10 plus years ago already. They're the ones who already lead the market in buy now, pay later. And here's the thing that I think a lot of folks and investors should be thinking about and thinking about where they're going to place their bets. We've got the Credit Card Competition Act of 2023 that's been proposed.
yeah,
And I think one of the potential implications of that, should it get passed, is that a number of issuers are going to struggle to maintain their two things. They're going to struggle to maintain their rewards program in the face of the declines they're going to see. And number two, they may actually struggle to be able to maintain providing credit to the lower end of the spectrum that they already provide credit to. So if some
just really quickly, just so
yeah.
because from what I read from your article, essentially this is meaning that not all these payments can simply just go through Visa or MasterCard. There have to be multiple networks that a payment choice can actually choose between. And so it's not just going to be a duopoly anymore, and that can open up to more fees and higher fraud and these sorts of things.
Exactly. And so one of the implications is that it might reduce the number of the amount of credit and number of cards that the issuers provide to the lower end of the market. What are people going to do, Tanner? They're going to rely more on buy now, pay later. They're going to rely more on those types of services. So with a strong base of both active accounts and larger share of the buy now, pay later market, I think PayPal in particular is very well positioned to capture that. And they're also, I think, behind, as I mentioned a little while ago, I do think they're kind of behind the game of both Square and Klarna in terms of building out the merchant network, but they're building it out. They're going to do it. They're a dinosaur? No, total mischaracterization of the company.
Sure, yeah. Now, another part in this article as well was you were talking about a large reason for why these digital fintech or digital banks and fintechs are growing much faster than the mega banks, community banks, regionals, was their spend on marketing. It's much, much higher. If I could read this as well, you said fintechs like Chime and PayPal outspend traditional financial institutions on marketing by a wide margin. And I learned this from your article as well. You said the industry rule of thumb is that banks spend around 0.1% of assets on marketing. That's quite interesting to know. But let's say if they were to ramp up marketing and be very similar to a Chime or PayPal, do you think that the services that they have to offer can actually compete with the likes or of a Cash App, Venmo, SoFi, more in my opinion user-friendly apps? But I am a Gen Z, so what do you think about that?
So let's go, if I can, refer back to the article, because remember I said the first point was the product differentiation. And I think that's what you're alluding to, but I don't think the traditional banks can simply double marketing spend and recoup the share. I don't think they have to do some sort of product alteration, improvement. And I think, here's the thing I would actually assert is that it's the community banks and credit unions who have the potential upside because they tend to deal with more niche markets, whether it's geographic community or affinity, special, employer groups from the credit union side. How is JP Morgan Chase going to change the traditional checking account to mirror? Well, so what they would do is they'd create a new group to create it. And that's been tried and it fails. It bucks up against the traditional structure and politics of the organization. So I don't think the large banks can really compete on the product innovation side. And I don't think the smaller institutions can simply just double marketing and expect the job to get done. And I don't think they can double marketing. It's just impossible within their budget and cost structure.
Are they even worried? Like, are these large banks, because like you're saying, the vast amount of these new accounts are kind of going towards the fintechs and digital banks, 47% this year. Are they worried going forward that percentage is going to continue to climb in the favor of the digital banks?
Is who worried?
Are the mega banks and these sorts of players where their total share of new accounts that are shrinking?
Yeah, I actually don't think the mega banks are worried or concerned about it for a couple of reasons. Number one is, of the accounts that they are opening, there's a demographic difference. They do tend to capture the accounts from older and more affluent consumers who are opening up new accounts. So they're more likely to sit back and go, hey, happy to let the Gen Zers go open accounts with Chime. And when they get big enough and old enough and become an adult, they'll come bank with us. That, I think, is the mentality of the large banks.
Do you think that's gonna be the case? That as people age, they will step away from the SoFis and go closer to a relationship with a city or something?
Well, I think in general they will age out of the fintechs. Your example of SoFi in particular, I I wouldn't have thrown SoFi there because I think they're building a set of products and services that could grow with the Gen Zers and millennials. But I don't see Chime doing that. I don't
Yeah.
see Varo. I don't see some of the others. But again, when you look at Square in particular, for all of their success, Tanner, remember that the demographic that they are either going after or attracting does tend to be the lower to middle income consumer. So I don't think Bank of America and Chase are particularly feel threatened by a lot of this, because they're simply saying, good, we don't want those consumers, or at least we don't want them right now.
Yeah. If I could, just a last question for you. This has been so much fun for me. You're a wealth of knowledge. I really do appreciate
Thanks.
your time, Ron. Seriously. I want to ask you, FedNow is coming in, should be coming in this month. Who knows? Uh, how do companies like the Cash Apps and PayPal's actually get affected as this transition to maybe a higher percentage of real-time payments starts entering, you know, banking in America? What do you think?
Um, I don't know the answer to that question, Tanner, because I have tended to look at the real-time payments, the FedNow opportunity, as impacting the banks and credit unions in particular, giving them new opportunities to kind of create new payment product offerings. Could be simple as early wage access type things. Um, uh, but there's a range of products and services. I'm I'm still somewhat either bewildered or pessimistic about the impact, because as I've looked at the list of institutions that have been announced as the early providers of this, they're all saying yes, we're in, and we're going to receive. We're setting up real time payments for receiving. But I'm like thinking, well, but if nobody is sending real time,
Yeah.
what good
Yeah.
is it to receive? And so until we see a larger percentage or players in the send side of the coin, I'm a little kind of pessimistic that we're going to see huge impact. But I think longer term, there's a big opportunity for the banks and credit unions to create products. But I also think that the bigger impact is probably on the B2B side than on the B2C side. I think there are clearly some good use cases for B2C faster payments, real time payments. But I think it's the big opportunity is in the B2B side.
Perfect. Thank you so much, Ron. Next time we'll have to touch up on, embedded finance, banking as a service, all those things that you've also touched on, things that, because I'm such a fan of SoFi, also, with
Yeah.
Galileo Technologies, have also touched in that area as well. But let's leave that for another time. Anything to promote, say anything like this that you want to share?
Hey, would love to have your viewers and listeners check out the FinTech Snark Tank on Forbes. You just Google FinTech Snark Tank; it'll get you to the homepage.
Perfect. I'll also have your links down in the description as well. So
Thanks a
thank
lot.
you so much, Ron. I
You bet.
appreciate your time.